Hello. Everyone, welcome back again as we continue from where we stop in our last class. We talked so much about Forex brokers in our last class. Today I would like us to treat Forex trading sessions. Please follow me word to gain fully. Now to the business of the day. Forex trading sessions. Now that you know what Forex is, why you should trade it, and who makes up the Forex market, it's about time you learn it when you can trade. It's time to learn about the different Forex trading sessions. Yes, it is true that the Forex market is open 24 hours a day, but that doesn't mean it's always active the whole day. You can make money trading when the market moves up, and you can even make money when the market moves down. But you will have a very difficult time trying to make money when the market doesn't move at all. The Forex market is made up of 5 important trading sessions, each named after a major financial center in a particular geography of the globe. These 5 sessions are Sydney, a city in Australia; Tokyo, also a city in Japan; Frankfurt, that's Germany; London, well-known city in Great Britain; and New York, popular city in United States of America. Try and get used to the trading session we have, as it's a great tool and useful to every trader. Next we will talk on Forex market overlaps. An overlap occurs when 2 Forex markets are open at the same time. During an overlap, the liquidity and the trading activity get maximized. In other words, these are the times which are best to trade, because of high volumes generated by multiple markets. There are 3 key Forex trading overlaps. 1. New York-London overlap, 12 to 16 o'clock GMT. This overlap offers the most active Forex trading hours, especially as concerns the 3 major European currencies, Euro, British Pound Sterling, and Swiss franc. Note that during 12 and 14 o'clock 3 markets are open simultaneously, New York, London, and Frankfurt. 2. Tokyo-London sessions overlap. 7 a.m. to 8 a.m. GMT. The Tokyo-London overlap begins with the opening of the 3 major European markets, London, Frankfurt, and Zurich, and lasts 1 hour. Most active pairs, Japanese yen, Euro, Great Britain pound, and Swiss franc. 3. Sydney-Tokyo overlap, midnight to 6 a.m. GMT. This overlap involves the intersection of many financial markets in Asia and Oceania, Tokyo, Singapore, Shanghai, Australia, New Zealand, and Hong Kong. Most active pairs, Australian dollars and US dollar, Euro and Australian dollar, New Zealand dollars, Australian dollars and Japanese yen. Have you ever asked yourself or someone else, what are the best time to trade? Let's have a look at the best times and days to trade Forex currencies. The overlapping times between 2 Forex sessions provide wider volatility, pip range movement, and the highest degree of liquidity. The best times to trade Forex. The London session is traditionally the most active Forex session as it involves transactions from a great number of European countries, UK and EU countries. The second most active session is the New York session. The overlap between these 2 sessions, London and New York, offers the best opportunities for currency traders. Note that during 12 and 14 o'clock GMT 3 markets are open simultaneously, New York, London, and Frankfurt. Now, is there a day for trading? And what are the best days to trade Forex? There are certain days in the week where all the markets tend to show more movement. When 2 sessions are overlapping, of course. These are also the times where major news events come out to potentially spark some volatility and directional movements. The European session tends to be the busiest out of the 3. The middle of the week typically shows the most movement, as the pip range widens for most of the major currency pairs. Tuesday, Wednesday, and Thursday. Fridays are also active until 17 o'clock GMT. Funny as it sounds, there are also worst times to trade. Sundays, everyone is sleeping or enjoying their weekend. Fridays, liquidity dies down during the latter part of the US session. Holidays. Everybody is taking a break. Major news events, you don't want to get whipsawed. Please don't hesitate to keep asking questions when I'm done concerning what we are studying. That's your ticket to a holistic understanding. Having done that, let's explore Forex terminologies. Talking about that we mean words or phrases used in this huge Forex world. In every discipline, there are different terminologies being used. If you are into agriculture, there are code words you use like mulching, thinning, pruning, etc. So also in Forex, there are different code words that are being used. Now, the reason why you must memorize and understand all the terminologies I will be telling you, is because if you don't know the Forex language, when pro traders are talking, obviously you will be in dreamland, wondering what they are saying. That is simply because you don't know the terminologies used in Forex. The most basic terminologies of all is buy and sell. In normal world, if you want to make profit on a commodity, you buy the commodity at a low price and sell it at a high price. This way, you make the profit. So let's say you bought 10 crates of Coca-Cola soft drink when it was at $20 per crate and you sold it when the price was $22, by now you have gained $2, isn't it? You can only profit when you buy a material at a lower price and wait for it to gain more value and sell at higher price. But when the price is coming down, it means the commodity is losing value. There is no way you can make money from a commodity losing value. Even if you sold gold at its current price, you will only make exactly the price it is presently. In short, in real world, in normal market, you can only make profit when price of a thing is going up, if you have bought it when the price was low. That's the normal logic, isn't it? But in Forex, when you buy, if the prices go up above the price you bought the commodity, you make money. Also when you sell, if the prices fall below that price you sold the commodity, you are still going to make money. This may sound technical, but I will explain it later when we are treating currency pairs. But at least you get a little glimpse of what I am trying to say. These things are getting technical now, so you need to follow me closely. Next terminology is long and short. To go short, which means to sell. And to go long, which means to buy. It's as simple as you just heard. We move to the next, bullish and bearish market. Originally, these words are borrowed from stock exchange. A bull is someone who buys shares, and a bear is someone who sells shares of a company. Don't forget I told you, each discipline in life have their terminologies. Now we are entering into the depth of Forex. If you don't know these things I'm telling you, you will just be looking. When you are reading Forex news, you will not understand anything. Bullish market is a market that is going upwards. Bearish market is a market that is going downwards. When someone tells you that a currency pair or a commodity is bullish, it's telling you that it's going up. People are buying the commodity. The buyer is referred to as bulls. The sellers are referred to as bears. On to the next one, ranging market. A market is said to be ranging if it does not have any particular direction. It's neither moving upwards nor downwards. As you can see in the picture below, the market is not really having a definite direction. Another term used is trending, a trending market. A trending market is a market that has a direction, it's either moving upwards or downwards. If the direction of the market is upwards, we say it's an uptrend. If the direction of the market is downwards, we say it's a downtrend. We stop here for today and hope to pick up tomorrow. Do well to digest this topic, you'll thank yourself later.